Hi everyone, this is Sandeep Malan. Today I'm going to talk something very counterintuitive, which is not all debts are bad debts. There are good debts too. You must be wondering how debts can be good when you owe somebody money. Now, trust me, in the initial days of investing, especially when we have very less capital, power of financial leverage really helps us amplify the process of wealth creation. And that is done by taking debts within the realms of certain safety aspects of ratios. And corporates utilize the power of financial leverage day in, day out. And that's how they transform, small and big ideas into large, profitable organizations. And the return on equity can be much higher when there is a certain amount of debt that is playing in the balance sheet. Now, we might or might not have voluntarily, involuntarily utilized the power of financial leverage in our day to day real life too. Buying a house is a classic example. There is a power of financial leverage that kicks in the real estate play, and it is utilized by big real estate investors pretty often. But in the world of equity investing too, you can get benefit from the power of financial leverage, and here is how it is. So before we start, let me make a few things clear. You need to understand three terms here. Equity, debt, which you might have heard. Equity is your owner share in any asset you purchase. Debt is the amount the others put, that is banks or financial institutions. Personal debt to equity ratio, which is simple debt by equity. And your equity is nothing but what you put. Or if you're having assets and liabilities, it's simple subtraction. Assets minus liabilities will give you net worth. And you divide your total debt over your net worth, you get your debt to equity ratio. Now, in a typical housing mortgage, you put 20%, banks put 80 percentage, and so your ratio is financial leverage. There, debt to equity is 4 times, right? 20 by 80. Now, if you're having a corporate, that debt is very high for your information, what you put in your house, because it's taken as a norm, because the banks approve it, and there is an underlying asset that you can see, hard asset like house. People tend to take 4 times leverage is pretty normal, but it's pretty high. If you, for example, if you're buying a stock of a company and you're doing an analysis of a stock of a company, and it has a debt to equity ratio of say even more than 1 or 2, people run away from that company because it's a high risk, and obviously it's just one company, you cannot afford all your asset on that. But that's how leverage is about. Now, how to really benefit, as I spoke in the video, from investing or from the power of financial leverage in equity investing. Now, let's take an example. You have $100,000 of total cash ready to invest. That's your total asset. Now you have 10K, that is $10,000 total liabilities. Now, what is your debt to equity ratio? $10,000 is your debt divided over your net worth is 90K, that is 100K minus 10K. That gives you a zero point 0.1 ratio. So your personal balance sheet is pretty strong that way. It's 0.1, it's negligible, the debt to equity ratio. Now, in equity investing, you could go up to 0.5 to zero point 0.7 times debt to equity ratio safely if you're investing in index funds. For example, Nasdaq in US, it doubles pretty much every 6 to 7 years, compounds at almost 12% over 10-year, 15-year periods. So in this case, you can take, in this example, you can take a debt of 45K. Why? Because a debt to equity ratio of 0.5 is 45K in this example. If you have a total, assets of 90K or net worth of 90K. So you could take a half of that and buy index funds. You can take loan, however you want to leverage it. Now, here is an explanation, right? Suppose you invested 90K, that your assets, and you have a leverage amount of say 50K, just taking some ratio between 0.5 to 0.6, and you put this total 90,000 plus 50K, that is 140K in the Nasdaq index fund. Suppose, let's hypothetically take 10 years back, exactly in randomly October 2010. And at that point of time, the Nasdaq was 2,400. It was trading at 2,400. Now 10 years later, this 140K would have multiplied 4.7 times, because currently Nasdaq is trading at 11,300. So 4.7 times means it's a compounded annual growth rate of 16.7%, which means the investments of 140K that you put would have become almost $0.65 million. Now that's 658K. In this example, now what is that you're left with? Because you have taken a leverage or loan, you would have paid some interest rate for that 50K. Suppose, say, roughly you paid $15,000 interest for 50K, which is very high. But say you paid that much, so you will have to pay, reduce that from your return. So 658K minus 15K, that gives you 643K.
And you suppose you have to also pay off your loan at the end of 10 years, right? So you have to pay off that 50K. So then you end up with 643K minus 50K, which is 593K. Now $593,000 within from an initial investment of $140,000 over 10 years is a very strong returns. Now this is the power of financial leverage. Had if you had not taken the leverage, the 90K would have still become 423K, which is still pretty good returns because Nasdaq has done phenomenally well. But you had, if you had put a 50K additional debt into that index fund, your returns is at least 30% higher. That is, instead of 423K, you would still now have 593K. And believe me, 30% higher returns on top of such a stupendous returns from Nasdaq is amazing returns in the initial period when you're starving for capital to multiply your wealth, compound your wealth. And this can really amplify and expedite the process of wealth creation, and at such a safe rate, right? Safe debt to equity ratio of just 0.5 times. And you're investing in index fund, which is even more liquid than your house. A house could take 3-4 months, even 6 months, 1 year to sell for a price that you need. But index is so liquid, you could just sell it, unless otherwise it's such a bear market, you don't want to sell at a price. It's easy, it's so liquid, and you are taking such a smaller leverage. So but you're amplifying your returns. It's just my point of view if you want to really multiply wealth quickly. Now, key takeaway from here: if you had put lesser equity in this, your amplifying financial leverage would have been, returns would have been much higher. So you would have, here in this example, you got a 7 times financial leverage returns. Whereas if you had lesser debt to equity, you would have much higher. Example, if in a house you put 20% leverage, I mean equity, and 80% leverage, suppose the house price doubles in say 5 years, you're so lucky you get a doubler in 5 years, that 100 percentage would have become 200 in 5 years. Now if you remove that 80K component plus the interest, say 90K, you are getting 110K returns free of cost, right? So that is a power of financial leverage. But in real estate we tend to utilize it, but not in equity markets. So maybe that's a good idea to do if you have not explored. Thanks for staying with me, hope this was helpful.